Steph, and a few other people. So welcome or welcome back if you have been tuning into these weekly or almost weekly sessions. Basically, long story short, is these sessions are meant for you to feel confident, whether it is that you're getting back into trading after taking some time off, or you're starting from absolute scratch. Just know that there is a space here for you. And we're going to do our best to make it super, super simple and eliminate any type of friction that is stopping you from mastering this craft, which for me has opened up so many doors. I never really say this anymore, but like I haven't worked a job since 2018, 2018, 2019. I think it was 2018, 19, just kidding. 2019. I've lived in different parts of the world and I'm so, 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 so grateful for that. Like my brain chemistry has been altered permanently. There's no way that I'd be going back to something that I am in, that I'm not super excited about. So I'm not saying that it's easy, but I am saying that it's worth it. So again, if I could eliminate some of that friction for you guys and have you live your best life, whether that looks similar to mine or different, then let's do that, right? Let's dive into market basics. I would love to chat and yap with you guys. I really would. But historically speaking, we're going through these concepts at a decent pace for about 50 minutes or so. So in order for you to get all the information that I think is important for you to understand and then be able to either tonight or in the next couple of days do something with that information, we're just going to dive right in. So this week's topic is market structure. This is one of those things where it's like it's so simple, but also it's going to be a reoccurring theme for your entire trading career. There are seasoned, like veteran traders that, and myself, that still get confused every now and then with the structure that we're currently in, or sometimes we question it, we doubt it, just because it could get a little bit of a overlapping or like a gray zone. So again, the quicker or the more confident that you feel about market structure, the overall better experience you're going to have with your analysis from here on out. So there's three directions that the market goes in. It can go up, it can go down, and every now and then it goes sideways. Not very exciting, but that's basically it. So like when you put it that way, the market kind of seems a little bit too simplified, right? There's obviously more to it, easier said than done. But that's really all there is. So like sometimes I make the joke of, you got a 50-50 chance, like you just choose one of the two buttons. And that's just not, that is not the right approach. That is not a profitable trading plan, or profitable entry strategy. Like, no, we're not doing that. We want something that's a little bit more just backed by actual analysis, actual understanding of what's going on, right? So up, down, sideways. Mostly today we're going to be focusing on up and down. Next week's session we'll be focusing on what to do when the market is going sideways. Can we take advantage of that or maybe stay out of it? All right. So the most basic thing that I can show you guys is what an uptrend is and what a downtrend is. An uptrend consists of the market making higher highs and higher lows. So I put the silhouette of a bull behind it because the phrase or the word that we use to describe an uptrend is bullish, like a bull. I didn't come up with these terms. These are terms as old as time. But you just think of a bull pointing its horns upward. And then for a downtrend or a bearish market, it's a bear. Think of a bear clawing down. So hopefully in some time in the future, if you're ever questioning what type of trend this is, you think of these images right here, take a mental snapshot, and it's going to be a lot easier from then out. The reason why it's so important to be able to analyze these things is to raise our probability of having the correct bias. Like I mentioned, we don't want to guess. We don't want to eeny, meeny, miny, mo in the market of what button we're going to press, whether the red one or the green one. We want to have a bias, which basically means, do you think it's going to go up or down or sideways? And we can do with that something next week. So if you think it's going to go up, we can look for longs or buy positions. for the most part. That's not to say that we can't look for shorts. We can. It's just a matter of doing a little bit more digging. If we are, and I'm getting ahead of myself, but bear with me. If we are going to go against the trend, that's called a counter trend trade. They can happen, but your probabilities are a little bit lower. And then the distance to which it goes is also lower. So it can still happen, but just keep those other variables in mind. That probability is a little bit lower, and the distance is probably also a little bit lower. So the easiest thing to do, and for me to teach you guys, is to go with the trend. When I first started trading, there was this lady that was teaching market basics, and she would always say, the trend is your friend, the trend is your friend. And again, I do believe that for the grand majority, especially starting off, but it's not to say that we discriminate. There's so much opportunity in the market. Okay, so on the left, the uptrend consists of higher highs, higher lows, higher highs, higher lows. And then very similar to like physics, where an object in motion stays in motion, a trend in motion also stays in motion until it's stopped by the opposite trend. And we'll get into that in a few slides. But these points, like the high point, the higher low, the higher high, the higher low, etc., those are called reversal points. I don't know if that's their official name for it, but it's basically where the market starts to reverse or correct itself. Also worth noting, and let me know if you guys think I'm going a little bit fast, but also worth noting, I should have had an image for this. I tried to make as many like visuals for you guys as possible, because I'm very much a visual learner, so I'm assuming a lot of you guys are too. But the anatomy of a trend, if you will, it consists of the impulse, retracement, extension, retracement, extension. And like I mentioned before, that goes on until it's stopped by the opposite trend. And we'll get into that later. So bullish trend, give me a 111 in the chat if that's making sense. Got to start coaching. Have a good session. Oh, is that Yamane? Oh, you're good, bro. We're notorious for having a good session. Oh my God. You are notorious for the fake springs. Oh yeah. Okay, perfect. Now let's just flip on over to the downtrend, bearish. Remember, think claws down. We have the impulse. So the starting move, if you will, is the impulse. Then we have the retracement. In this case, the retracement is actually going up because the overall theme is going down. So that counter trend is the opposite. It's going up in this case. Extension, retracement, extension. So high, higher low, higher high, higher low, higher high. I have different words on the one on the right. That's my bad. But it's supposed to be a low, lower high, lower low, lower high, lower low. You'll see whether it's myself or Mike, we don't analyze our charts when we're doing like live analysis. He doesn't really analyze his charts with the higher highs and higher lows anymore, because for lack of better phrasing, let's just say that we're kind of past that. Whenever I do like a beginner friendly analysis, like chart markup, I will put the higher high and higher low points just so we can see it and get used to it. But the good news is that your eyes will get used to it. Just put in the practice, put in the reps, and you will start to see it without even, almost like it's involuntary. And that's called unconscious competence in terms of the levels of learning, where you don't even need to make a conscious effort. You just have an understanding or an understanding of something. So next image, a little bit different, but now we have same points, same trends, but we have different verbiage. So for an uptrend, we call these highs weak highs. The reason why we call them weak highs is because they get like broken through, if you will. think of it as like a styrofoam ceiling. Like it doesn't really sustain much. So we can like plow right through it. So that's why they're called weak highs. The lows are called strong lows because they are respected. So in an uptrend, we are disrespecting the highs and respecting the lows. The reason being is that if, let's say that this reversal right here where my blue dot is, if this were to come any lower than that previous low, remember how I mentioned before, a trend in motion stays in motion until the opposite trend comes in. And that's what that would be. If we no longer respected that previous low, now we are in a different trend. Or now we have other things to consider, whether it be a fake spring, manipulation, etc. But it's no longer respecting the market structure, the textbook market structure. On the right side with the downtrend, we have strong highs and weak lows. Now, why are the highs strong over here? Is because they're being respected. And the lows are weak because they're being broken through. So that's just the continuation of the trend. There's different ways that you can think about it. If this confuses you, don't worry. Let's just stick to the higher highs and higher lows, lower lows and lower highs, whatever is simpler for you. I'm just giving you guys all the vocabulary so that when you hear it from other people, whether it be Mike or if you follow other traders, then you don't feel lost. Again, my mission is to eliminate all the friction. Anything that you think seeps in a little bit of doubt or confusion and that causes you to kind of like stray away or get turned off here, we're eliminating that. So that's why I give you all the vocabulary so that you understand no matter who's speaking, because a lot of this vocabulary is interchangeable. Okay, more vocabulary or more phrases. Break of structure. So the break of structure is another way of saying continuation. Now, this one might cause a little bit of confusion to different traders because you have to remember that different traders learn from different people. There's not just like this one way of learning trading, one way of learning foreign exchange or futures, right? Like we didn't all go through the same course. So there is a little bit of confusion in the market. The textbook way that I learned is a break of structure is actually a continuation. So just think of it as breaking through in the same direction, breaking through in the same direction. If you remember last week's session, remember that those are like the buy stops and sell stops when we're breaking through in the same direction. So that's a break of structure. I think they could have named it something else, but it's not for me to say. In this case, the break of structure is actually at the lows. Because remember, we're going in the downward direction, and we're breaking through in that same direction. That is called the break of structure. Or let's just call it the continuation of structure, because that just sounds weird. We're not really breaking anything, whatever. All right. And then let's circle back to why are we learning this to begin with? It's a simple concept. Like, does it really matter? Yes, because we have higher probabilities of being right and higher probabilities of it going further. Remember that we make money when it comes to trading CFDs or futures, we make money by being right in our bias, in our directional bias. And two, the points that the market goes in our direction. I'll say that again. We make money two ways. One, well, with two things. One, being correct in our directional bias. And two, the distance in which it goes in that direction with us being in the position. So if we see an uptrend in the market, it is more likely for us to be able to take advantage of buys or longs, right? We could get in some sells, but just know that we are going against the trend. So you'd have to be more precise and you'd probably hold it for shorter period of time. Now, there are exceptions, but we'll also do that lesson a different day. In a downtrend, we are more likely to catch sells or shorts. And while we're here and we have the visual representation of what a position looks like, right? The long and the short. The reason why this is important also, no matter what type of trader you are, whether you're a scalper, intraday trader, swing trader, or even a position trader, when you know the bias, the directional bias, right? And you keep that in mind. Something else that we can use that information for is where to position our stop loss. Remember that we have two exits when it comes to the market. We have our stop loss, which is our protective invalidation when the market is not going in our direction. And then we have the take profit when we want to tell the market, okay, I'm good with these gains. Thank you very much. So when it comes to strategy, your exit strategy, it's a good idea, at least it has worked for me, to put that stop loss at the previous low for buys and at the previous high for sells. Why? Let me know if anyone in the chat can tell me why it's a good idea or why it makes sense to me. Putting our stop loss at the previous low for highs, I'm sorry, a previous low for buys and the previous high for sells. Strong low or strong high? Yes. But what's the thought process of why would I put my stop loss there? We're following the trend. Yes. So to further explain that, you're right, Stephanie. To further explain that is if the idea, the whole concept here is if we're following the trend, then this low should be higher than the previous one, right? It should respect the previous low or the strong low. Then why would I need my stop loss any lower? So in terms of risk to reward, I can have either a higher lot size if I'm trading CFDs or bigger contracts if I'm trading futures by narrowing down or getting more precise on that stop loss to give me a better risk to reward. I'm just getting more efficient based off of the information that I've collected. Does that make sense? Market likes to respect those areas. Exactly. Due to it being a prior respected level within the overall trend. Yes, perfect. All right, great, guys. So that's why we use them. And the cool thing is, and we'll get into this in just a little bit, but the cool thing is that this works on multiple time frames. The market, think of the time frames in the market, right? The main time frames are the monthly, the weekly, the daily, the 4 hour, the 1 hour, and then you can get into like the 15-minute, 3-minute, 1 minute, and you can get into seconds. Those are time frames. Some of you were here when I showed an image of what a candlestick looks like, right? And if not, just either draw it out on your notes or just make a note to take a screenshot of a candlestick. But those candlesticks, they tell us where price opened and where price closed. And then the space in between makes up the candlestick, right? So to give us a visual aid of that, we use time frames. Okay, this is where the candle opened every 4 hours or every new trading day or every 1 hour, right? And then we can zoom in and get more detail by going to smaller time frames. We can zoom out or get a bigger picture by going to bigger time frames, right? So looking at structure, and it should be coming up soon, looking at structure, it's really important to do it on the time frame that you're trading on, but also always go one bigger at minimum. And I mean, you guys can live your life, but I think it's a really good idea to always go one bigger. It's like you taking a step back and just making sure, like, do I have this right? Yeah. So whether it is that you are scalping and you're trading on the 1 minute time frame, or whether you're an intraday trader and you're trading on the 1 hour time frame, or you're a swing trader and you're trading on the 4 hour time frame. Structure, the concept of structure stays the same. The concept of being able to put your stop loss at the previous low also stays the same. So you're going to take this no matter what type of trading you do. Cool. All right. So let's rewind it back. A trend in motion stays in motion until it's stopped by the opposite trend. So what does that look like? Okay, here we have an uptrend first, and then we get a reversal. That reversal, or the shift, or the change of structure, is called a change of character. ChoCh. ChoCh. I think ChoCh sounds like a really funny name, but that's what they call it, right? So it's the opposite of a break of structure. So here we have a high, a low, higher low. Notice how this one broke through the ceiling, so it broke the structure, and it's going in that direction. But then it stopped doing that. Instead of giving us a higher low up here, we actually got a lower one. So like, now we're not going in the same direction. There's two really important points here, reversal points. One is the initial one that stops the trend, if you will. So the change of character, right? The change of character stops the trend. But the point after that is the stamp of approval. So one more time. If we're going on an uptrend, we have the high, the low, higher low, higher high, higher low, higher high, higher low, higher high. If we don't get that higher low and we actually get a lower one, that's the change of character. That's where we should be thinking like, oh, I think this uptrend is either making a macro retracement or it's just done for now. And then the stamp of approval for that, what really constitutes it or cements it, is the next point. If we get a lower high, in this case, now we're starting to see the opposite trend take over. Lower low, lower high, lower low, lower high, lower low, lower high, lower low, until it's taken over by the next or opposite trend, right? Let's rewind a little bit. Let's go back to this point over here. Remember when I said it cements it? There will be times when the market gives us this change of character, but then it just continues the previous trend. And that is called manipulation or fake out. So that's why I said 2 points really make it like for real. Whereas if it was just one and then it continued going up, that would be a fake out or manipulation. And we'll get into that in either next week or 2 weeks from now. Okay, so let's go back to the whole reversal. It was in an uptrend, and then it turned around to a downtrend, and then it continued in the uptrend. So this part right here is a counter trend of the bigger time frame. Yeah? Give me some ones in the chat if you're following. That the middle part right here is just a counter trend of the bigger time frame. Perfect. All right, easy peasy. So now let's do the opposite. We went from buys to sells. Now let's see what it looks like going from sells to buys. So going from a downtrend, we have the week low, strong high, week low, strong high, or we can call it the lower low, lower high, lower low, lower high, lower low, no lower high. We actually have a higher high. So that's the change of character, right? These were the break of structure, and then we didn't get a break of structure down here. We got a change of the overall structure. So now we're probably going bullish. And I say probably because it's not cemented until we get the next reversal point. Then we have a higher low. This point right here is higher than the previous one. So we got a higher high and a higher low. We are no longer going in the downtrend anymore. That was the reversal. So when we were looking for shorts before over here, after this guy comes in and we start to move our way back up, are we still looking for shorts? We could, but then we might get ourselves caught in the opposite momentum, right? So the easier thing to do would be to look for longs. In this case, wait for a retracement, look for longs. I should have had a visual of this as well, but when price is relatively high, that's called premium pricing. You're paying a premium, if you will. When price is relatively low, that's called discounted pricing. Simple enough, right? So when we are in an uptrend, we want to get in at discounted pricing. When we are in an uptrend and we want to get out of our long positions, we want to get out at a premium pricing. Let me say that again. For buys, for longs, we want to get in at discounted pricing and get out at premium pricing because we're buying. That's the trend that we're going in, right? So think of a house. You want to buy a house when it's worth 200K. You want to sell it when it's worth 400K, right? Obviously, that's a macro example, but bear with me. For shorts or sells, we want to get in at premium pricing and we want to get out at discounted pricing. We want to get in when price is high. We want to get out when price is low for shorts. For buys, it's the reversal. We want to get in when price is low. We want to get out when price is high, right? You buy low, sell high, buy low, sell high. Okay, beautiful. So this is a visual representation of what we could do with that information. Remember when I said you have a higher probability of being right, and you also have a higher probability of just taking it further? If you have ever seen anyone, honestly, it doesn't even matter if they snipe a position, but they're riding that thing out, they're going with their trend. If you've seen anyone like share their screenshots on social media and they've been holding a position for like weeks, maybe even sometimes months, they're going with the trend. So this is their soft skill that's kind of running in the background. Even if they're advanced as traders, they no longer have to consciously think of like reading out the trend anymore, but they're still going based off of that. So remember when I said this is going to be a skill that you just keep with you for the entirety of your trading career or your investing career. So again, you want to buy at discounts, sell at premiums, buy at discounts, sell at premiums. We're going to take this one a little bit further, one level deeper. Let's say that we buy here and we're in an uptrend and price hasn't quite gotten to our take profit yet. If we start to see price reverse, some people that don't know any better could panic and say, I'm losing all my profit, or I'm giving all my profit back to the market, right? But if they were to remember that the overall structure is still bullish, all they have to do is withhold that retracement because we have a good chance of it still continuing to the upside because the overall structure is still bullish. Give me twos in the chat if that makes sense. So even if that next extension doesn't hit your take profit, a hard pill to swallow or an inconvenient truth is that we could still just wait for a retracement for the further extension later. It's going to take more time. We might have wished, oh, I should have taken out sooner and then gotten back in. Yeah, maybe. But that gets into how to choose your exit strategy for take profits. And that is a lesson entirely on its own that we will get into in a few weeks from today, because it really is one of the more important things when it comes to trading. So it deserves its own lesson for sure. All right, perfect. Okay, so once we get the change of character, are we looking for buys at the change of character? No, we could, but the probabilities aren't in our favor. So like you can shoot your shot, see what happens. But again, if we are here to focus on getting our probability for profitability up, then in this case, if I were to see that change of character, I would just sit on my hands and let the market show me what it wants to do. Let it show me that lower high, or it could also show me that it actually still wants to continue going up. That's fine. You don't have to get in every single move the market makes. That would be so exhausting. We would be glued to our computers all day, every day. What I think is the best like work-life balance for traders is getting your skill set at a good enough level where the probabilities are in your favor after you analyze, and then just being detached from missing out on some moves, because missing out on some moves is just necessary for you to get more context, more clues. Okay, so if I saw this lower low, I wouldn't get into buys. I would wait to see if the market's actually going to give me a lower high or a higher high. If it gives me a lower high, then I'm going to start to shift my bias. Instead of looking for buys, I'm going to start to look for sells, because it's just more probable. That's the trend that the market's going in. And then this is where we also go back to the conversation about time frames. If this retracement is just that, a retracement of a bigger time frame, then those shorts are going to be not permanent. We'll put it that way. They can be long enough for you to get a few positions in, especially if we're on a big time frame like the daily time frame, the weekly time frame, the monthly time frame. We can ride that out for days, weeks, and months, right? But if we are on the 1 hour time frame and we see this retracement, am I looking to hold a short for multiple days, weeks, or months? Probably not. So again, we want to remember where we're at in the market regarding price, but we also remember where we're at or what we're looking at regarding time frame. Yeah. So we want to see the charts and price action, but we also want to remember, what time frame am I focused on? If I'm only focused on the 1 hour, then I wouldn't expect to hold a position for weeks or months. If I'm only focused on the 1 minute, I wouldn't expect to hold a position for even a few hours, right? So that's why I mentioned before, decide, and that's probably a lesson in itself too. Decide the type of trader you want to be. Trading is something that you can build a la carte, customizable trading plan according to your personality, your availability, and your risk tolerance. We're not all created the same. Some of us are a little bit riskier than others, and that's okay. The reason why some people say trading doesn't work is because they were trying to adapt a trading style that fits somebody else. We just don't have the same taste. We don't have the same personality, and we're setting ourselves up for failure if we think that adopting this person's exact trading plan is going to work for us and having that expectation. You got to know yourself. That's why trading is honestly such a big blessing, because it challenges you. I would say it forces you to get to know yourself. Okay. So real quick, if you are someone that's super, super, super short on time and you only want to dedicate a very short window of time to your trading, and you want to be in and out of the market, then maybe scalping is something that you consider. If you're someone that has really, you're short on time, but you want to, like, you don't want your heart to race for little candles going up and down, then actually I would consider intraday or swing trading, where you can check in on your trades, but it's going to take some time to play out, multiple days, maybe even a couple of weeks. If you are someone that is super detached and like you don't care if this takes months, then you could be a position trader. I honestly don't know many position traders. There's some that just like take advantage of a few opportunities, and that's great. But I think for the most part, when people think of trading, they think of scalping, intraday, or swing trading. That's just the most popular, if you will. What am I? I would consider myself an intraday trader. It's been a long time since I've held a position for more than a few hours. And I don't really know why that is. I'm just kind of like, I want to trade in the mornings, put my laptop away, and then get right into like my other work. So after like 9:30, 10 a.m., I'm usually not looking at charts anymore. Like I'm done. I don't care if another position or opportunity comes up. Like I'm good. I'm really detached though. Like that's also my personality. I'm really detached. Mike, on the other hand, he will be looking at charts at 8 a.m., 1 p.m., 3 p.m., 7 p.m. Like he'll just do like check-ins and he'll take the trades. So again, you have to know your personality and your availability. Um, yeah. Okay. I think I finished that train of thought, but I will do a session on just finding out your trading style another time. Let's continue back over here. All right, so time frames. I thought we talked about this already, but I guess not. So if we are looking at a time frame, we want to go bigger for direction. Remember, think bigger time frame, big picture. So bigger gives us the overall direction. We want to go smaller for detail. So bigger for direction, smaller for detail. This is an example of two charts on top of each other, if you will. And obviously they just look like lines right here, but follow along. So let's say that the black bold line, or this overall trend, is the daily time frame, right? And then the blue line, let's say that that's the hourly or 4 hour time frame. There's going to be one on top of the other, or I should say one inside of the other. So this is what it would look like if they were to just be layered on. Obviously, your chart isn't going to show you that. That's why you got to think about it mentally and then zoom out yourself or zoom in yourself. I think another way or a better way of looking at it is like this. So the black or the gray in this case is the daily. D is for daily. And then 4 hour is the 4 hour time frame. So inside of even the impulse of the daily, this is going up, right? Inside of that, the 4 hour time frame also has its own trend. In this case, it's also going up. Where it gets a little bit more nuanced is in the retracement. So here we have the daily retracement, right? The pullback, if you will. Daily retracement, pullback, same word or same meaning. So this could be just a retracement on the daily time frame, but if you're only looking on the 4 hour time frame, then it just looks like a bearish trend altogether. And those are like same, but different. Let me explain myself. They're same in the sense that they're both going down. The difference is that the 4 hour, it looks like it's going down further because the time frame is smaller. I hope I'm not confusing anyone with that. Another way to put it is that the daily, when you're looking at the daily, it looks a lot more temporary because you have the entire picture in frame. Let me think of another way I could explain that. I'm thinking of an analogy. I'll have to come back to that. But basically, on the daily, it'll just look like it'll look more clearly like a retracement. On the 4 hour, you just might think that that's the overall trend that it's going in. So that's why I always say just go up one more time frame at minimum to make sure that you have the big picture of things. Okay, it is pop quiz time. So I'm gonna do my best to give you guys a little quiz or maybe some homework after these sessions, just to really make sure that you're grasping it, that you're not just like putting this video on in the background as background noise. Like if you're cooking, cleaning, or scrolling right now, I don't know what to tell you. Like actually, I can't even be that mad because I would do the same thing. But it definitely sticks more with repetition and with implementation. So that's what I'm trying to do with y'all, okay? All right, pop quiz. A structure consisting of higher highs is a what? A, is it a ChoCh? B, is it bullish? Or C, is it bearish? B's across the board. I'm really bad at snapping, but you guys got it. Structure consisting of higher highs is bullish. It is in an uptrend. Higher high, higher low, higher high, higher low. You guys get the point. Excuse me. Okay, nerds. In a bearish structure, when price breaks beneath the previous low, it's considered a what? Is it a higher low, B, a change of character, C, a lower high, or D, a break of structure? Let's see. Is this the new one? Okay, so in a bearish structure, when price breaks beneath the previous low, is it a higher low, a change of character, a lower high, or a break of structure? Okay, it seems like this one confused you guys a little bit, but that's okay. So the answer is a break of structure. I think almost nobody got that one. So let's go back to a bearish structure. So remember, in a bearish structure, when price breaks beneath, breaks lower than a previous low, right? So let's go to a bearish structure somewhere over here. This is bearish. When it breaks, there's another one. Here we go. When price breaks beneath the previous low, it's going in the same direction. It's just breaking, or it's not respecting that low. It's a break of structure. The reason why it's not a lower high is because we're breaking beneath it, and the highs are up here where the premium prices. The lows are down here with the discounted prices. So let me make sure that everyone thought that was pretty clear after the explanation. I was going to say, wouldn't that be a lower low? Yes. So it would be a lower low, but a lower low wasn't an option on the options. Yep. I see. That's why I tricked you. I gotta make sure you're paying attention. All right, I think we got two more. Okay, in an uptrend, when price creates a lower low, we are going up, and it creates a lower low. It's considered a weak low, B, weak high, C, break of structure, or D, change of character. Okay. Yes, it is considered a change of character. We're no longer creating higher highs and higher lows. We're creating, this is a lower low. It changed the overall direction of the trend. Beautiful. Nicely done, guys. Okay, last one. When price action is showing higher highs and higher lows, it is more probable to look for a lower low, B, weak lows, C, buys, or D, shorts? Bunch of nerds. Yes. So when we are in an uptrend, we're more likely to be profitable looking for buys versus shorts. In an uptrend, we're not really looking for lower lows, and we're not really looking for weak lows either. So C is the correct answer. All right, guys, that is this week's session. We are right at the end of the hour. So that's why I told y'all, like, we got to get right into these things because I do repeat myself a lot. The reason being is because I do think that repetition is the way to really learn something, really cement it, get it embedded in your reticular activating system, get it embedded in like your memory storage. So if you feel like you need to rewatch this, I will be uploading the video. Hopefully it doesn't take me as long as it did last week, just because, well, last week I was in Utah, so, distractions and fun stuff. But I have a few different places to orient you guys, send you guys to, depending on what it is that you're looking for. Bottom right, we have Tradetopia.store. That is where you can find traders merch. Basically, I don't see many people, or any actually, have streetwear catered to progression, a progressive mindset, growth mentality, or trading related things. Like, you just don't see that unless it's just like this, like, not that cool thing. Just gonna put that out there. We also have freebies. So if you want to take a look at free resources, free PDFs that we have on there, you can also download them on the store directly. And then that's also where we'll be posting our upcoming retreats. So basically it's a hub for everything. Now, the big QR code is we have decided, because we've been asked to, we have decided to create a fast track cohort. A cohort is basically a group of people that are doing something together. So we have decided to create a guided fast track cohort that's only 30 days. So if you have been liking these sessions, but they're kind of at a slower pace than you would ideally like to have, then maybe this is for you. It's going to be guided. You're going to have accountability partners. There's going to be worksheets that go along with the sessions, and it's just going to be at a more hands-on style where I'll be checking in with you and just quicker pace. You're going to have all the modules. You can go through them in a day if you want to. You can take the whole month if you want to. My goal is to get you from A to B in 30 days so that we're not dilly-dallying and we're not taking longer than we should on this. And then you can just move on and graduate to the next step. Like, let's get this out the way and let's get into the real stuff. So that's that. The lower QR code is our free community. I'm assuming that you guys are already in there by watching this video live with me, but in case we got some stragglers from YouTube and the recording, then we do have a free community where we have a whole bunch of other videos, a whole bunch of other free resources in there for you. And it's just a really, I wouldn't say too intimate because there is thousands of people in there, but like the vibes are right. So if you've been looking for a trading community, consider this your new home, as long as you are in alignment with what we got going on. So if you're not already in there, there's lots of free resources in there. The majority of our content is free. So if you are receiving value, I kindly ask that you share, subscribe, share with a friend, just so we can continue to help other people. We've been in this industry for 9-10 years, and I feel like we've seen it all. Our mission here is to shift the sentiment of trading and steward our skills so that people have a fair chance of succeeding in this, if that's what they choose to do. If not, then cool, live your life. And I hope, like, I wish you the best, sincerely, genuinely. So yeah, guys, that is today's session. I'm going to write out the watch list, and I have to figure out a more efficient way of doing these sessions where I can give you all the information that you need and also dedicate some time to the stocks watch list. There's not a whole lot of change between the last watch list that I sent out. So majority is just going to be a repeat of that, but there are some things that are at discounted prices. If you have some disposable income that you would like to put in there, then I will be sending out that watch list momentarily. Well, I wouldn't say momentarily. Your girl's got to sleep, but I will be sending it out in the next day. Got my shit a couple weeks ago. Oh, nice. Karen got her hoodie and she loves it. Beautiful. The pictures always help. I'm so glad. All right, guys. Well, thanks so much for listening in, watching, and playing along. Yeah, tune in next week for we'll be doing another session going over, this was market structure. We're going to be going over consolidation or that sideways movement and what we can do in it. And then either the week after that will be kind of more curating a custom trading or finding out what a better trading style for you will be. So I'll see you on those. And then remember, the mic goes live every day, Monday through Friday on YouTube for the free ski. So in case you just want to keep on hanging out and getting things for free, then, make sure that you check those out as well. All right, guys, gotta go. Have a great night. Drink some water. Do what you got to do. And I'll see you for New York session.